Okay, so why can't Canadians afford a new home? Why can't young Canadians? Why is it harder for almost all Canadians to afford a new home? Let's jump into this. There's tons of nuance to this, obviously, but we put a bunch of this into a presentation that we can kind of skip through. So here is the average Toronto real estate prices. And this topic applies to all of Canada. I'm picking on Toronto here a little bit just because some of the data is easy to grab from the Toronto Regional Real Estate Board here. Here are Toronto real estate prices going back from the late 60s, 70s, 80s, and all the way to current day. You can kind of see it kind of peak out in the 90s. There was like a 6-year pretty deep recession in this country here. And then it just goes on this like wild and epic nonstop run, has a little blip in 2017. And here we are here. It's come down a little bit, but you can clearly see the trend of real estate prices. And now if we go ahead and dive into that a little bit, and if we just take, for example, the year 2001, and we look at the average price of real estate at $251,000, and we skip ahead to 2023 and we see the average price of real estate in that year at about 1.1. If we calculate the compound annual growth rate, we figure out that it's growing at 7.16% on a compound annual rate. So real estate from 2001 to 2023 on average went up 7.16%. And that's compounded every single year. So this is a really important number to keep in mind, this kind of 7% number. Because now if we skip ahead and we go to Stats Canada and we look at incomes in this country from 2001 and we skip ahead to 2023, we can see and we can calculate the compound annual growth rate of incomes from that same time period. And if we do that calculation, we figure out that although real estate is growing at a compound annual growth rate of 7%, incomes are growing at 2.98% or roughly 3%. So that's like a really massive gap in the growth rates. And as that continues throughout years, it creates this widening gap between real estate prices and incomes that becomes eventually insurmountable unless you have down payments being gifted to you or interest rates go really low for long periods of time. You can't really afford the home. And here it is mapped out even longer. This is real estate prices going all the way back to 1969, the top line there. And there's incomes from Stats Canada mapped out at the bottom. So you can see what happens. Incomes are growing, but they're growing at a much different rate than real estate. And that's the reason, that's a big part of the reason why you can't afford a home in this country, that you have this like widening gap. It's a widening wealth gap, if you will. And if we skip ahead even further and think about this a little bit more deeply, like, are there other factors? What is happening here? Like, what is happening under the covers here? And to do that, we need to understand a little bit about Canada's money supply, referred to as M2, the M2 money supply. And you can see the M2 money supply in this country grows over the years. It goes up and up and up. And here where we are, the latest reading is about May 2024. And if we dive into this a little bit, think this through. What does everybody have as their assets or their net worth? And I guess I shouldn't say everybody, but what do a lot of people have? And they have, some RRSPs, perhaps, maybe some savings, a lot or a little bit, maybe a stock portfolio. Those are pretty common. Maybe you don't have any of that, but you have some comic books. Maybe you have some valuables at home, some paintings, a watch or something, whatever you might have at home, just really anything. Like, what is, if you added everything that you owned in your name up, what is that? And I would refer to that as your purchasing power. That's like your net worth, and that is your purchasing power. Some of it's liquid purchasing power, some of it's not so liquid. But if we were to add it all up, that is your purchasing power. And when you think of it in that way, when we look at M2, so if I skip back to M2, let's say your purchasing power, we added up everything you owned and what it was worth, the comic books that you have, some art, some stock portfolio, maybe some cash in a bank. And let's say that added up to $100,000. This could be any number, but let's just use that as an example. Well, what does that represent as purchasing power in May of the year 2000? If this was all the M2 or all the money supply in the entire country, your $100,000 as a percentage of this would be some percentage, right? You owned that much of the entire country's money supply. Well, what happens is every year, Canada creates more and more dollars, devaluing those dollars as it does that. And if you don't continue to grow your purchasing power, if you don't continue to grow your comic book collection or your art or your stock portfolio or your RSPs or your savings at the same rate, you're falling behind. Because what's happened from the year 2000 to May 2024, the money supply in this country has changed quite a bit. So if your purchasing power hasn't changed at the same rate, you've fallen way behind, because now, let's say that $100,000 of purchasing power that you had when we added up all the assets in your name when we started this little discussion, as a percentage of the M2 money supply now, it's grown so much that your percentage ownership of that purchasing power in this country is a much smaller rate. Your $100,000 represents a much smaller amount of Canada's M2 than it did back in the year 2000. And the reason for that is the government just keeps creating in this country more and more dollars. And we're all slightly guilty of this. I'll explain in a second. But that's one way to think of your purchasing power. If your purchasing power does not keep pace with the growth of this M2 money supply, you're falling behind. The percentage ownership that you own of this is falling behind. And it's a really weird concept to think about, but it's important to understand. And the compound annual growth rate of the money supply in this country from May 2000 to May 2024 is 7.11%. So roughly 7%. And at that rate, the purchasing power of the Canadian dollar that you have gets cut in half every 10 years. So every 10 years, everyone looks around and says, wow, why is everything like so expensive? Well, it's because we're devaluing the amount of dollars by printing more of them and stuffing more and more of them into the Canadian economy, that it's devaluing the ones that were already there. And we do this at such a rate in this country that every 10 years, your purchasing power is just cut in half. So when people look around and they're like, well, why does it take so many more dollars to buy groceries or houses or anything? It's because the amount of dollars in the system just getting increased, and it's increased at a 7% rate every year. So if the value of your stock portfolio, your savings, your comic book collection doesn't go up in value at 7% a year, you're falling behind. You're never mind getting ahead. To get ahead, you would have to grow your purchasing power more than 7% a year. But you have to at least grow your net worth, your purchasing power measured against M2 at 7%, or you're falling behind. So like, why does real estate do a good job of keeping up with this M2 debasement? And why don't incomes? And part of the reason for this, that real estate, because remember we said when we measured real estate, it was going up about at a 7% compounded annual rate as well. So that's kind of interesting. Like, why is real estate keeping up, but incomes are not? And there's nuance to this, but a few things that we can think about is that our money isn't money in the way we think about it. It's actually debt. Our money is actually debt. It's really weird. Like, it's very rarely discussed, but all money in this country is created by creating debt. Every dollar that comes into existence in this country is created by creating new debt. So as M2 grows, it's always growing because new debt is created somewhere. And so what creates debt? So like, what creates debt? If money is debt, what creates this new debt? And new debt is created in wild and wonderful new ways. But one of the ways it's created is tapping your credit card. When you go for lunch and you tap your credit card to pay for lunch, it's not like Visa, MasterCard, or Amex had that money sitting in a bank vault somewhere and they were going to send it to the restaurant once you've tapped your card. No, what happens is new money is created out of thin air every time each of us goes and taps our Visa card, our MasterCard, or Amex card. These companies create money out of thin air and send it over to the restaurant to pay for lunch. You've created new debt on your credit card, and in the process, you've created new money. It's kind of ridiculous, but that's how M2 grows as well. That's how the money supply grows. Another way is that the government spending more than it earns creates new debt. When governments create deficits, when they spend more than they have collected in tax revenues, they fund that deficit by issuing bonds and debt and creating new money out of thin air. So sometimes, and there again, I just want to pause here because any real technical people in the fiat world are going to say, well, it's not always creating new money, which is true. We're not going to get into that in this discussion. But when deficits are created, if there's no one funding those deficits, then the central bank will just create it out of thin air. And it get a little complicated, but that's the overall message. Even getting a new loan for a car, you're creating money out of thin air. You got a new loan. The bank that issued that loan, the lending institution that got that loan for that new car, doesn't have the money sitting in a bank somewhere. When you sign the paper to get the loan for that new car, you've magically created new money out of thin air. So every time anyone takes on new debt, they're creating new money. Getting a mortgage is another way that we're creating debt. When you go to the bank and you get a mortgage for a property and you sign those mortgage documents, again, it's not like the money was sitting in the vault somewhere. You've created new money out of thin air in that financial institution that is going to send the seller of that property, if you're buying it from a new home builder or from another person in Canada, when they get that money dropped in their bank account from you getting that mortgage, that money that was dropped in their bank account is brand new. You created it when you took on new debt. So this is a really important concept to try to understand. Your income is dependent on someone else creating new money, and then you get some of it. So when you're earning an income in this country, you're not creating new debt magically out of thin air. You're doing some work, exchanging your time and labor, and someone is paying you an income for that. You're getting a salary for that. So you're not creating new debt. You aren't first in line for any of the new money. When you're working in this country, you're not getting the new money first. I would argue that you're kind of getting the new money last, which is horrible. But it answers why some things are growing at a compound annual growth rate at a different rate than incomes, because incomes are lower on the ladder of getting access to any new money. So where are you on the access to new money ladder? It's something to think about. But when you understand how the money system works, you realize that income is kind of like one of the lesser ways to get access to new money. Let's go into this a little bit more. So if I go back to this chart and I look at house prices versus salaries, we kind of know now that, house prices go up at this rate, 7% compounded, incomes go up at about 3%. But there's other factors into why Canadians can't afford new homes. So there's the whole money system, but then there's also these structural issues in this country. So, in Canada, when I was younger, we were getting about 250,000 people in this country through immigration, and the population growth was like a little bit larger than that. Now, the population growth from the year 2010 to 2015 was quite a bit larger, almost touching 400,000. Then in the later part of the last decade, it really spiked up. Then we had the pandemic where it kind of just disappeared for a little bit, and now it's just kind of done a rocket ship move and gone way up. So when you have a population growth that is really growing like this, it puts strain on home prices if the quantity of homes don't increase. And Ben Rabideau does such a great job of putting out this data. That's his handle on Twitter. Highly recommend following him on Twitter because he puts out all this wonderful stuff. And if you look at just single family building permits right across the country, here's Ontario on the right-hand side. Single family building permits in Ontario are at the lowest level going back all the way to the 1980s. And our population growth clearly is different than the 1980s. Here's British Columbia. Its single family building permits are really low. And when you don't create new single family homes as fast as you're creating the population, this is another factor into housing affordability. And some of that, some people will argue, will say, well, condos have increased and rental property builds have increased, rental apartments and rental condos. And that's true, they have. But it's also why people can't afford a single family home is that because the dollar system, as I was describing with the M2 money supply, is making single family homes so expensive, it's difficult to qualify for a home, but there's also not as many homes being created right now. So some of that gap is being filled with smaller rental properties and smaller condos. So it's harder to qualify. And so the market has responded saying, well, if it's harder to qualify for a single family home, we'll just produce smaller homes, these things called condos, and maybe you can qualify for this instead. So that's kind of the market adapting. I don't really like the way the market has adapted. I like being able to afford a home. But again, there's just so much nuance here. People will argue that not everyone needs to own a single family home. Maybe, because of urban sprawl, more people should rent in the city core and more condos are good. I'm not here to debate that point. I'm just here talking about why it's harder for Canadians to get a new home. And then here's the Canadian government budget deficit. And you can see when this line goes below zero, the government is running a deficit. It's spending more money than it's bringing in. So you can see pretty much if you follow this line all the way through going back, 50s, 60s, 70s, 80s. There's a little period here where it goes above zero, where they actually had a bit of a surplus, and then it kind of dips down again, and then it dips down in a huge way. And I would argue that, I'm banking on it coming down again. And when the government is constantly operating in a deficit for decades at a time, it just has to fund that deficit with new currency units that it creates, this M2, and the M2 just grows and grows and grows. And if your income or your assets, your purchasing power doesn't grow at the same rate, you are going to be falling behind. So why do people who own real estate seem to get ahead? The reason for that, in my opinion, would be they can create new money. I put great. I guess it is great that they can create new money out of thin air, but they can create new money with credit lines on their property. So anyone who owns real estate can actually act as a banker themselves, because if you own a piece of real estate, and if you've owned it for 5, 10, 15, or 20 years, there's likely, through you paying down some debt on the property or through some magical appreciation, going to be some equity in that property. And the banks take real estate as collateral. So you can go to the bank and say, hey, I would like some money. And they'll say, okay, well, do you have any equity in your property? And if you say, yeah, they'll then respond saying, hey, sign this paper. We'll give you some access to that equity. And if that equity is 250 grand and you sign that piece of paper, you are magically creating 250 grand out of thin air by creating a credit line that you can access. So real estate owners can create new money just like bankers can. Income earners cannot do that. So if you own property in this country, you can create money out of thin air just like Visa can and MasterCard can and banks can. It's one of the reasons people who own real estate can get ahead. It's also one of the things that's happening in this country with that is how older Canadians are accessing some of the equity in their properties and gifting that money to younger generation to be able to buy a new home. So there are more and more Canadians or more first-time home buyers who are getting gifts in this country from the older generation who's tapping into equity that they have and then gifting, if you're lucky enough to have parents or someone who's going to do that for you, gifting that to you, and then younger generation using that to help them buy a home. That's definitely a trend that we're seeing. So now imagine somebody owns multiple properties. So for example, imagine someone owns multiple properties like rental properties. Well, then if that's the case, you are really skipping ahead, I'll say, because you're putting 20% down to buy a rental property. If that rental property, on average, we know that real estate is going up 7% a year on average. It's not every year. In our example, we took the year 2001 and went to 2023. So we took like a multi-decade example. And if you go back even longer in this country, 7% is about the compound average annual appreciation rate of real estate. So if it's growing the property price at 7%, but you only put 20% down, well, then the return or annual gain that you're getting is 35%. And this is really, really important because now a real estate investor is getting a return of 35%. So they're getting ahead at a 35% rate. While the M2 money supply, if we go back earlier in this discussion, we talked about the M2 money supply growing at about a 7.11% rate. So the currency is getting debased at 7%, but they're growing at 35%. They're keeping ahead. They're beating that 7% by quite a lot. This is why leveraged real estate investors tend to get ahead in this country. Their returns are greater than the debasement. Leverage is dangerous. You need to know what you're doing. Some people over leverage themselves. Definitely, you should give it some thought before you do it. But this is why real estate investors tend to get ahead. They're getting a faster return. And then over time, just like the real estate example where we discussed tapping into the equity that you have. So after you've had multiple rental properties for a certain amount of years, you likely have some equity in there. You can go get a credit line on there, and now you can create new money from the rental property. So not only are you getting ahead from an ROI point of view, but you can then create money out of thin air. They're basically kind of working the system the way it's designed, but the way it's also never discussed. So real estate is closer to the new money than incomes are. You create new money from accessing debt, The debt in real estate is the easiest to get because you can use real estate as collateral at the banks, and they will give you some new debt. They will give you a credit line. They'll give you another loan using your real estate as collateral. So real estate owners are closer to the new money. And then real estate itself is closer to the new money because the most amount of debt is created from mortgages in this country. So real estate benefits from that from a price point of view because all the debt's coming in through mortgages, and then it goes into the real estate first, so the real estate prices respond accordingly. So real estate allows you to create new money. I'm not saying any of this is right, but that's just kind of the name of the game. There's this chart that I stumbled upon. We did not put this together, but I stumbled upon this chart. Looks like it's from Exponential Age Asset Management. And if you look at all the things on the left-hand side of this chart, you can see kind of the rate of return across different years, and it's annualized on the far right. And you can see right across the top, there's another asset that we like a lot called Bitcoin. There's a few imposters here called Ethereum and Solana that I'm not really huge fans for technical reasons that we're not going to get into, but Bitcoin is permissionless and decentralized and secure. It's a pretty magical asset that's kind of came into existence in 2009. And it has a really great annualized return. Even the last 4 years, as I'm recording this in kind of mid 2020, it's about a 50% compound annual growth rate through the last 4 years. So there are other assets that can beat that 7% M2 debasement rate that we discussed earlier. And this makes for a nice combo, in my opinion. Real estate and Bitcoin together, and you can kind of throttle this however you like. You can have 10% real estate and 90% Bitcoin. You can have 90% real estate and 10% Bitcoin. But together, these two assets are rather powerful in my opinion. And basically what we're all trying to do here is we're all trying to outpace this 7% debasement. That's what we're trying to do. We're trying to get ahead of this debasement rate so that your purchasing power, your income, your asset base, if it's not growing 7%, you're not keeping up. And if it's just growing at 7%, you are just keeping up. You have to grow your net worth, your income like 10% a year to quote unquote get ahead. Right? And real estate allows that through the leverage that we discussed, especially for investors. The leverage is what's getting them ahead. You have to be smart with the leverage, but that's what's getting them ahead. And real estate owners get to create new money out of thin air, just like governments kind of do, by accessing debt. So incomes just don't allow you to do that. So part of the reason that real estate benefits so greatly, and this line at the top grows so much, is that real estate, because it's closest to the new money, because it's closest to the debt through mortgages, the new money flows into real estate much sooner and faster than it flows into incomes. And as a result, layering structural issues in this country as well, between lack of housing and population growth, those things matter as well. But all these factors together just have things like real estate growing much faster than your income. And if you're solely depending on your income to buy real estate, you just have to be aware that your income isn't keeping up with real estate prices, and it puts you between a bit of a rock and a hard place. So it's unfortunate that's the way it is, but that's how it goes. So if I was to bring this all together, new money M2 is created out of thin air through new debt, through tapping your Visa card, taking a loan for something, getting a mortgage for real estate. New debt is creating new money. Incomes get access to the new money or the new cash very late in the game, because with incomes, you're not creating new money. When you go to work and get a salary, you're not creating new money. You're getting someone to give you a salary from new money that was created in debt somewhere earlier in the cycle. So you're not closest to the new money. So that kind of puts you at a disadvantage in this money system. And things that get access to the new money go up much faster than your income. And because real estate is much faster to the new debt, the new money, it goes up in price much easier than your income does, in our humble opinion. Take that for what it's worth. So where are you on the access to new money ladder in Canada? This is something we would challenge everyone to think about. Like, where are you on the access to new money ladder? Is your access to new money are you low on the ladder, or are you higher on the ladder and you're able to access new money rather quickly? I would say banks are really high, right? They get to create money out of thin air as part of their business. The credit card companies are really high. But then you can put things to your advantage that if you can get access to some real estate, you can create new money out of thin air yourself. If you can manage the leverage smartly, you can get access to this whole money game as well. If you're solely depending on income, you're not really getting access to the new money early in the game. You're getting access to the money very late in the game. If you like this, we put out a bunch of videos on real estate investing on YouTube. You can go to youtube.com/Rockstar Inner Circle and subscribe. And hopefully that gave you some insight into why it's harder and harder for young Canadians to afford a home in this country.